So hello everyone, and welcome to today's edition of our monthly webinar. Manzur Goshe here with the Interest Group with you. Glad you can all join us. Our topic today is selling real estate, an expert introduction. And our guest speaker is none other than David Coe of Coe Real Estate. I met David many years ago, and one thing that kind of struck me about him is his passion for real estate, his passion to educate his buyers and sellers, both residential and investment properties. I actually remember David always calling me, inquiring about self-directed retirement plans, how they work, so on and so forth, to learn more about it and to better educate his clients. So I'm really thrilled to share the mic with David today. But before we get started, there's a disclaimer that I have to read out to you. The Interest Group does not provide any investment advice nor endorse any products. All the information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So our agenda for today, I'll talk a little bit, maybe 3 minutes or so, about the Interest Group, what our role is, what we do and what we don't. And then David will take the mic, and there's his agenda. He'll speak a bit about historic property pricing, how it relates to self-directed IRAs and its overview, preparing your property, pricing your property, marketing it, and then finally closing escrow. And after David's presentation, we'll have a bit of a Q&A session. So feel free to type in your questions. We'll take them, time permitting, at the end of David's presentation. So this is a little bit about myself. I'm the Regional Business Development Manager at the Interest Group. I serve the Southwest region. Been with Interest for about 20 years, and we educate investors and professionals on tax-preferred retirement accounts. CISP certified, which is a certified individual certification that we have in the self-directed IRA world. So a little bit about the Interest Group. For those of you that are not familiar with us, we're one of the oldest and largest self-directed IRA providers. We've been in business for about 40 years with over $4 billion in investor assets under administration, almost 45,000 investors. We differentiate ourselves in that we have a single point of contact for our clients. So depending on the region that you reside in, you'll have a dedicated office that you'll be working with, allowing you for faster transaction times with your investments, which is critical in our space, and also for better customer service. We are self-directed IRA administrator and custodian. We work with individuals looking to invest in alternative investments such as real estate, limited partnerships, LLCs, precious metals, et cetera, et cetera. We don't sell any products or give any sort of advice, whether it's investment, financial, tax, legal. So a self-directed IRA really is not a type of IRA. It's just a term used in the retirement industry for a retirement plan that allows you to invest in all these types of permissible investments. So it allows the investor to take charge of making all their investment decisions solely. It allows you for greater opportunity for asset diversification outside of the traditional stocks, bonds, and mutual funds. All the securities and investments are held in a retirement account administered by a regulated custodian or trustee. So this brings us to our main presenter, David Coe here, that's going to take it over. I'm very thrilled to have him on our webinar today. Welcome, David.
Thank you, Manzur. Oh, well, I guess we missed this one, or
yes, I think we discussed that.
That one, yeah.
Yes.
Okay, good. All right. Well, hey, first of all, Manzur, thank you. It's good to be connected again. you know, I've actually been working with Munzer. We're probably over 10 years now that we've been, you know, working on different things together from when we first met. So I've learned a lot on the self-directed IRA space through, you know, spending time with Munzer and Intrust and working with other custodians as well. And, you know, I'll give you a quick overview of who I am. So, you know, primarily in the middle there, I run a real estate team called Coe Real Estate Group. We specialize in working with investors, but we do handle both residential resales as well as new construction homes. So I've got a division of my team that specializes in new construction. We're based in the South Bay of Los Angeles. I'm also the general manager of our brokerage, Keller Williams Beach Cities. And then I also run a real estate investment club called For Investors by Investors, or FIBI. And, you know, that's probably where most of my experience in dealing with self-directed IRAs has come. It's from working with different investors. I myself was a self-directed IRA investor. I'm now a self-directed 401k investor. And, you know, have a lot of clients that have invested in real estate using self-directed retirement projects. What I thought was interesting when I got the call is, you know, I used to do so many presentations on how to buy assets in a self-directed retirement account. You know, it's the first time I've ever been asked to present on selling assets, and, you know, there are some things to think about. So, you know, for today, my agenda is I am going to take a look at some historic pricing. I think it's important right now, if you are thinking of selling an asset, is having a good understanding on where we are in this market cycle. I am a local realtor, so take everything I say with a local realtor grain of salt. But I'm also involved in a lot of different investments from around the country. I network with a lot of different realtors all over the country, and it's just something that I'm really passionate about. So I've got some slides to show you that I think will kind of help to position where the market is. I've only got a few slides specifically on self-directed, and I put here overview. It's really the overview on the sales process, and there are some things to think about, and you know, we'll kind of spend some time on that. And then really the rest of the presentation is just going to be about how to optimize the sale of your asset. And whether it's a retirement asset, it's an asset that you own outside of your retirement account, it's your own personal home. This is kind of our playbook for, you know, how to optimize the sale of any real estate asset you have, mostly a 1 to 4 unit asset that you have. And then what I'll do is I'll kind of pepper in information along the way that I think is relevant for self-directed IRA investors. So the first few slides I'm going to go through, I am a Keller Williams agent, and Gary Keller, we actually had a big meeting back in this, actually it was February of 2022, and we were just on the cusp of the shift happening. So these slides are a few months old, but I think they're still pretty relevant. You know, and I think the information from these slides are information that we are still you know, sharing with our clients and experience in my business on a day-to-day basis. You know, one of the biggest things when you think about real estate is obviously you have to think about supply and demand, right? And when you have an oversupplied market, prices tend to go down. When you've got an undersupplied market, prices tend to go up. And usually when we talk about over versus undersupply, we usually use 6 months of available inventory or months supply of inventory is what we'll try to look at when we're talking about the supply of homes. And, you know, as you might imagine from what you've been reading for the last, you know, 2 years specifically with COVID, we are down. These are nationwide stats. In 21, at the beginning of the year, we were less than a 3-month supply of homes. In the South Bay of Los Angeles, and where, you know, my primary business is, at the beginning of January of this year, we had less than 1 month supply of homes. And because of that, prices have moved as you might expect. This is a historical look at pricing, and, you know, the yellow line is the long-term average, when you look nationwide, this goes back, almost 30 years to 1990, that the average rate of inflation, so to speak, on residential real estate is about 4%. And when you look at that, you can see it's been pretty, it's been pretty consistent. Obviously, in 2005, 2006, there was all kinds of artificial demand created by loose banking products. And then 2008, is when the crash started, and then we reverted well below that norm in 2011, which was kind of the I guess the valley of the housing recession. I can still remember first quarter of 2012, all of a sudden the entire world woke up and we were just like, wow, where'd this come from? This is great to get back to business. And prices have been climbing pretty steadily ever since, but we never got back to that norm until 2021. And even at the beginning of 2022, we were already starting to project a leveling off of prices because we had finally prices had kind of overstepped that 4% annual line. So, from a national perspective, we've been looking at a stabilization in the housing market here. And that was before, Ukraine was invaded by Russia. We started having inflation, rates started to change. All of those things, I think, are symptoms or certainly moments of impact that are starting to stabilize housing prices. A big question we get all the time is there going to be a crash or is this a correction? And again, keeping the number one principle in real estate in mind, which is supply versus demand. I think probably the biggest thing, and you can point to Dodd-Frank, some rules that were put in place after the 2008 meltdown, that are underwater homes, which really we look at as kind of distressed inventory, is way below where we were, when you start looking back, even in 2010. Actually, if this chart went back further to 2008, 2009, I think a portion of homes got into the 30% that were underwater. Okay, and what underwater means is that the value of the home is less than the actual mortgage debt on the home. As of quarter 3 21, only 2% of homes were actually underwater. Part of that has been, I'd say the useful application of sound lending practices enforced by Dodd-Frank. And then part of that has just been the skyrocketing price of home values in the last couple of years. So even people that are having some distress, they have equity to play with for the most part. And what we're not going to see in 2022 or 2023 is this huge inventory, surplus of homes because people are either having to short sale their homes, verge of foreclosure, their adjustable rate mortgages were getting ready to reset. They literally just couldn't afford their homes, and they knew that they were way over the value of the homes when they bought it, so they just walked away. A lot of that kind of distress that we were dealing with in 2009, 2010 is not what we're dealing with right now. For the most part, people around the country are in fairly stable situations as far as their mortgages are concerned. So we see this as being something that's going to have a major impact on the housing market moving forward. I think some other impacts that we're looking at is, when you really look at 2008, 2009, we had a major drop in new home starts. So obviously, developers in 2005 and 2006 got caught holding a lot of inventory when we had the change in the crash that started happening in 2007. And housing starts, which really on average, we should be right around that, 1,000. I think that's technically 1,000. So we should be building about 1 million homes a year, and we have been under that for a long period of time. In 2021, we finally got past that 1 million level. We were at 1.1 million new construction home starts. But if you've seen anything in the news on new construction home starts in 2022, builder sentiment is down. Very similar to where I think we were in 2007. Builders are less confident of the market moving forward, but it's not as much about demand and oversupply as it was in 2008. A lot of it's about the cost of building materials, the cost of labor, the availability of labor. I think it has as much to do with the actual process of building a home as much as it does with any doubt that there might be a market on the back end. So I think a lot of builders are kind of finishing projects that they have. We work with a lot of builders. That's absolutely what we're seeing. Not that they're not building anymore. They're just not taking on any new projects. They want to finish what they have and then maybe see where they are in the next 12 to 24 months before taking on new projects. So we think that's important because, again, we still think that we are going to be in this undersupplied market for a while. There's been a lot of talk about recessions, and I think, there's recency bias, right? So everyone thinks that usually when we're in a recession that real estate prices crash. And I think it's important to kind of look at, there's two slides here that I'm going to take you through. The number one is looking here at what Fed actions do, right? So whenever we are having high periods of inflation, the Feds will generally start pushing up their rates. And then once we get into a recession, which, if you could technically say we are in one, we've had 2 quarters of negative GDP growth. Obviously, that's a highly debated topic right now. But regardless, I think what you're going to start to see is that now that inflation, I think, is starting to stabilize, that the aggressive action by the Fed is probably going to start to loosen. And we think that this is going to have an impact on interest rates as we move forward here. So what mortgage interest rates mostly respond to, it's less about what the Fed is doing, and it's more about inflation. Inflation is horrible for mortgages. So with inflation finally starting to stall, the Fed's already talking about maybe not raising rates as high as they have been in the beginning part of the year. And, a lot of lenders that we're dealing with are now starting to project stabilization, maybe even a decrease in interest rates moving forward. And if you are in the process of selling a property that you own through your IRA, your buyer won't be an IRA investor. They're going to be a retail investor looking at retail rates. So it's important to understand some of this if maybe you're trying to time the market and figure out when's a good time to sell. One of the things about real estate is that, it's usually a hedge against the economy in general. And again, recency bias, if you look at what happened, real estate crashed during the last major recession, right? So look, they had a small recession in 2020 with COVID. That was maybe a quarter or two, and then it quickly, you can see the housing prices skyrocket after that. Obviously in 2008, that was a major correction in real estate, but that wasn't as much due to recession as it was a lot of bad mortgage practices prevented lenders from lending. For a few years, it was really hard to get a traditional loan just because banks had so much toxic assets on their books. They had very, very tight underwriting standards on what they were giving new loans out. But if you look historically back through time, real estate has generally done fairly well during a recession. Sometimes there's been a slight increase. Sometimes prices have stayed fairly stable. Really, the only time, maybe other than the 60s, where we've had a radical decrease in real estate pricing has been in the 2008, our last major market recession. But we don't think that was as much a supply and demand issue as it was more, a banking issue, with banks both A, limiting the availability of loans they were willing to make, and B, flooding the market with homes that they had to take back in through foreclosure or allowing short sales on. So our projection is, whether or not we are in a recession or not, what we're seeing on a day-to-day basis is stabilization in the housing market. So if you're thinking of selling and you think, look, I got to get out now before there's this 20% drop, we just don't see that. We think prices are going to hold pretty steady. So let's kind of move in now to the second section, which is the self-directed IRA overview. And as Munzer mentioned in his his intro, really a self-directed IRA, it's just an IRA. And what we like to say is it's an unrestricted IRA. Now, there certainly are some rules on what you can and can't do, but most IRAs are restricted by the custodian that's taking control of the assets. And most major financial institutions want to keep you obviously investing in more cash-based opportunities, stocks, bonds, mutual funds, cash position, things like that. Self-directed for us really means unrestricted, right? And probably the biggest thing that you need to be aware of with a self-directed IRA when selling the asset, because at this point, you've already bought the asset, right? You've already kind of gone through what you can, what you can't do, the asset that you own, the way you've been using it, you're probably handling that properly. But as you go to sell, I think the biggest risk that you have as a self-directed IRA investor is dealing with disqualified persons. So as a reminder, anyone up and down on your family tree is a disqualified person. So you, your spouse, your parents, your grandparents, your children, your grandchildren, anyone that's a lineal ascendant or descendant is someone who is a disqualified person. Now, if you go horizontally on your family tree, cousins, siblings, anyone that are, kind of left and right on your family tree are okay to deal with. But I think, some of the most, biggest red flags you want to keep an eye on is who you're dealing with. And who you're dealing with means a lot of different things, right? So let's say you're a realtor and you want to sell your property, right? You selling your property in your self-directed IRA and taking a commission in your own name is a prohibited transaction. Sweat equity is an amazing component of owning real estate outside of your IRA. But inside your IRA, any type of sweat equity that you want to put in could be considered a non-cash contribution to your IRA and could subject the transaction to some prohibited transaction rules. So maybe you're really good at painting, maybe you're really good at plumbing, maybe you're a carpenter, you want to add a deck. All of those things are things that will absolutely increase the value of your property, but you can't do them. Now you can hire someone to do them, and just make sure when you hire them, you're not hiring either yourself or a lineal ascendant or descendant. Don't have your kids come in and help build your deck because he's a contractor, right? Or don't hire a disqualified party to list the home, right? Because your mom's a real estate agent. If you have someone that in your family that does, is either an attorney or depending if you're in a closing state that closes over the table with attorneys or an escrow or mortgage company, anyone within the process of selling the home needs to be someone who is a non-disqualified party. You are clearly the biggest disqualified party from your IRA. Remember that you and your IRA are two legally separate entities and are not allowed to kind of commingle together, right? So, these are probably, as I went back and thought about it, some of the biggest things that you want to be careful of as you're prepping your home, even as you own assets inside your IRA and you're just managing it. I think these are things as a reminder to kind of, keep top of mind. There are some taxes on sales of IRA-owned assets. By now, I hope if you have a leveraged property, you're pretty aware of these. I think the two that are most important are UBIT, right? And basically, UBIT, or unrelated business income tax, is a tax on non-taxable entities that make profit unrelated to their purpose. And the best example I ever got on this when I was learning, and Munzer, it could have been you, it's been so long, was, if you have a church that has a gas station on their property and they're leasing it out, even though the church is a nonprofit, the gas station is an unrelated entity for the reason of them being non-taxable. So while the proceeds of the church would be untaxable, the sale price or the profit on the gas station or whatever lease they got from that land would be taxable even to a non-taxable entity. Where I think this most comes into play on the IRA side is if you're fixing and flipping inside your IRA, right? If you buy a home or two every year and you fix it up and you resell it, you could probably get away with being a hobby or an enthusiast more so than running a business. If you're fixing and flipping 5 homes a month, right, the IRS is probably going to consider that you're running a business inside your IRA and you have an unfair competitive advantage because you don't have to pay for taxes and they may want to tax you on that. So, you know, if you're getting ready to sell an asset and, you know, maybe it's going to be 1 or 2 that you're going to do a year, you're probably okay. But if you're fixing and flipping inside your IRA, this is something that you need to be very aware of and get professional advice on how to handle. The other one is UDFI, which stands for Unrelated Debt Financed Income, and it deals with leverage profits on a non-taxable entity. So if you bought your property all cash and have no loan on the property, then you have nothing to worry about with UDFI. What UDFI is meant to do, it's the government's way of saying, look, the money that you saved inside your retirement account, you're going to get the tax advantages allotted within the IRA or 401k or whatever type of account you're in. But the money that you borrow is money that you do have to pay taxes on. So, you know, let's say, for example, you put a 40%, you bought a house and you put 60% down and you took a loan for 40% against that and then you sell it. Well, 40% of those profits will be subject to a tax, 60% wouldn't. And I think what's important from the standpoint of this discussion today is maybe when you bought it at 40% with a 40% loan, but now the value of the property and the fact that you've been making payments on that loan, maybe you're only leveraged now at like 30% or 25%. So the way the UDFI is calculated, it is based on the level of debt that you have, you know, usually at the beginning of the year. I'm certainly not a CPA and do not claim to have any expertise on how this UDFI is calculated. I'll send you back to your own tax professionals to do that. But something to think about before you sell the property might be trying to eliminate that debt in enough time prior to sale so you can avoid the UDFI tax. And there are different ways of doing that. I'm not going to go into all of that right now. But the easiest one is maybe you have other cash inside your IRA and now you decide instead of purchasing another investment, maybe you want to use that cash to pay off the loan and then sell the property to avoid the UDFI tax. So, you know, the UDFI is both, you know, certainly a potentially negative impact on your profit. But if you understand how the tax works, it could also be an opportunity, and it's one that you should consider and certainly have good discussions with your financial advisors prior to deciding to put that asset on the market. All right, so that's the self-directed IRA part of it. Mostly what I'm going to go through here on out is really just talking about some of the do's and don'ts on selling a property. You know, I am primarily a listing agent. You know, we do about 70 to 80 transactions a year. So this is my specialty. And, you know, there's really 3 main pieces of selling a property. You know, obviously, number 1 is getting the property ready. Number 2 is pricing it. And number 3 is how you market it. And we're going to cover all 3 of these. So the first thing I'd advise you is if you're getting ready to sell an asset is have a plan, right? Like the best real estate sales that we have, it's not that, hey, listen, I want to list it. I want to get the house on the market this Friday. Most homes need some prep before they hit the market. You know, we need time to put marketing together. And, you know, this is a copy of our typical steps that we do prior to putting a property on sale, right? If time were no object, you know, generally the process of getting something ready, especially something that needs a little bit of work, is typically 5 weeks of time. Now, we certainly can shorten that up, and we've had to extend it out depending on the property, depending on whoever the seller is. But I think it's important to understand that, you know, don't just make a rash decision. You know, if you're going to work with someone, which you need to, right, make sure that you come up with a plan of attack before you start, you know, promoting the property. You know, some of the biggest things that I think you can do is add curb appeal, right? So this is a listing of a property that we had. You know, we gave it a little bit of time, cleared it out, a little paint, a little landscaping, and, you know, that initial impression of what you see walking up to the property makes a huge difference with buyers. Nothing probably has more impact than decluttering, right? So getting all of your personal stuff out of the property, right? Getting photos of your family, anything that's religious, anything that's political, anything that you know, might get in the way of a buyer envisioning themselves into the home is part of decluttering it, right? And the impact of an open space is huge with a buyer. So if you're moving, you're going to have to take that stuff with you anyway, right? We always, I mean, we go through a very detailed process with our clients on highlighting the things that we want them to remove from the property to get it as clean and simple as possible. And then, you know, well, I'll get into staging next, but staging is hugely important. Kind of playing off of the curb appeal is also entry appeal. So as a listing agent, my advice and guidance to all clients is that 90% of buyers are going to make up their mind within the first 30 seconds of walking into the home, right? So they've walked up from the curb, whatever curb appeal you created, they walk in the front door and they see what they see. And then everything that they see past that first 30 seconds is either going to reinforce their decision to buy the home, or it's going to reinforce their decision not to buy the home. So as you're looking at investing into a piece of property, getting it prepped for sale, you know, your curb appeal, and then what does the house look like where a potential buyer is going to walk in, you might even want to, you know, kind of focus your dollars on those particular items. How important is it to stage a bedroom? Not as important, right? Because usually the bedrooms are later in the house, and by that point in time, people have already seen it. How important is the backyard versus the front yard? Well, the backyard's not as important because by the time they get to the backyard, they've probably already made up their mind on whether or not they want to buy the house. So as you're looking at a budget, whatever you have on prepping the home for sale, invest the majority of those dollars into the things that are going to create early appeal for a potential buyer. And staging is key. We are nuts on staging. We get involved in all different kinds of staging. Not everything needs a complete restage. There's partial stages. There's all kinds of different staging and different assets that we bring to the table. But, you know, this is a house that was built in 2005. It was a nice home. You know, guy owned it, single guy. It was very heavy, very dark. This is the exact same house with professional staging in it. So staging is relatively inexpensive, right? Even to stage a home like this in Southern California, this was probably a $6,000 or $7,000 stage, which may sound like a lot, but if you think about the cost of construction, painting, all other things that you might do, staging is a relatively inexpensive item that has a huge impact on your ROI. So, you know, think about the impact a buyer's going to have when they walk in, and make sure that you give them the best possible impression of the home, you know, to help you get as much profit as you can. The next thing we'll go through is property pricing. And, you know, I think this is really important right now, is to know your comps. As we're pricing homes right now in a shifting market, we are really focused on comps that have happened in the last 60 days. So generally an appraiser is going to go back and look at the last 6 months of comps, you know, anywhere from half a mile to a mile of whatever the subject property is. You know, and that depends on the density. You know, where I live, you know, I could swing a rope and hit, you know, 19 of my neighbors. We're very dense by the beach. If you're someplace that's, you know, has larger yards, more space, you know, maybe an appraiser is going to go out a mile even further. But what you do need to know is that the comps the appraiser is going to give the most relevance to are the most recent ones, right? So when you're in a shifting market, which we are, right, a property that closed in July is going to have a lot more weight in appraiser's eye than one that closed in March, right? So as you're either doing this research yourself or working with a real estate professional to kind of determine what's the value of your house, I would say it's probably the biggest tip right now is, give more weight to most recent comps. And then understand where you fall on this timeline, right? Like this is a property in Hermosa Beach that we comped out, right? Obviously our prices out here are a little higher than the rest of the country. This was a kind of a median priced home in Hermosa Beach. And understand where your property lies on this kind of continuum. Are you an average property? You've got average condition, you've got average placement within the neighborhood, or are you an above average property or a below average property? If you're a below average property, there's an opportunity to create value by using staging, doing some remodeling, and getting some things done before you put it on the market. But it's important to know your comps, because once you have a good sense of your value, you want to make sure that you price it properly. Do not overprice a listing. This chart on the left shows the percentage of buyers that you would attract to your listing based on where you are in pricing relative to the market value. And clearly, the more conservative you are on pricing, and by conservative, I mean, like, let's say you're going to price it, 10% under market value. It doesn't mean you're going to end there, right? But what it does mean is that you're going to appeal to a higher percentage of buyers that are looking in that price point. Buyers are pretty savvy, right? Especially buyers that have been beaten down for the last 2 years because they had a hard time getting their offer accepted. Well, they've got a lot of market activity, a lot of market knowledge, and they have a pretty good sense for when a property is both overpriced and underpriced. The other thing to think about is the timeline on when you've been on the market. Generally, that second to third week is when you're going to get the highest amount of eyeballs on your property. It usually takes a week or two, to kind of, for your property to kind of, fill in marketing that you're running to kind of hit whatever the marketplace is. Realtors that are, might be on vacation or a buyer that may be on vacation that comes back. Usually that third week is where you're going to see most of your market activity. But if you're overpriced at week 3, right, you're going to be on a problem, because as you correct price over the course of the house being on the market, you're going to get exposed to less and less buyers, right? So it's super important to price it conservative and price it upfront that way, right? Versus trying to overprice it and reach and see if you can find dumb money. There's not a lot of dumb money out there. Most money is pretty savvy, right? You're probably going to be looking at a smart buyer, because even a dumb buyer that gets in might realize they made a dumb mistake halfway through escrow and cancel escrow. And now you're 5 weeks in, and then you have to lower your price, right? And now you're talking to a smaller percentage of the buying population. So this is a really big part of successfully selling a property. The advantage of marketing it conservatively on a pricing standpoint is you want to be in a multiple offer situation. Okay, so this is an example of a property where we got 4 offers in, and we go through and we look at, the offers. How much cash did they have? What kind of financing did they have? What kind of contingencies did they have? So as a seller of a property, right, I now have 4 potential buyers, none of whom know who each other is. And the way you get a high price for the property, it's not by pricing it high and finding the one buyer willing to pay it. It's by pricing it low, getting multiple offers, and then using the multiple counter process to get people to bid against other people who they don't know and don't know how much they want a property, right? If someone writes an offer and they get a counter on it, the buyer has started to find an emotional attachment to the home, right? They're already starting to move in. Which room are the kids going to get? Which room's going to be my office? right? And all of a sudden now they know they're in a multiple counter, and now this is where someone might do the dumb move of waiving an appraisal and going $100,000 over asking price. Now you've got a much better buyer than if you're trying to get that buyer up front by overpricing the property. So this is our process, the way we like to do it, and we find that we get more value for our sellers and in a faster timeline by underpricing it and hopefully working the multiple offer process. The last thing is marketing, so to expose the property, I can't say enough about professional photography. I consider myself a pretty decent photographer, but this is a phone that I took. This is actually one of our investment properties. Now, I never intended to use this property for marketing. This was just me taking a photo with, my iPhone, which again, I consider myself a pretty good photographer. This is that same view with a professional photographer that has much better equipment. Now, granted, the first one wasn't staged. This one now has staging in it. But just to give you an idea of the difference between a professional photographer, versus you trying to do the photos on your own, photography is huge. Beyond photography, videography is also big. Certain consumers, especially with social media, and I'm going to go through some slides here in a minute on where people find out information. Some people prefer video versus photography. This is a version of a video that we created, right? You already saw that you've got aerial drone photography here, right? We're kind of flying in, we're showing this particular property. Videography is important, and a lot of photographers, I won't make you guys watch the whole thing. A lot of photographers and videographers kind of do it as a joint package. So make sure whoever you're hiring to do the marketing of your home really uses top-notch photographers and videographers to capture the essence of your property. And why is that important? Because look at the stats, right? So even in 2021, the percentage of people that looked online, the first step in the buying process, they looked online for properties for sale, 41%. And then even if you looked at the third one down, they looked online for information about the buying process. So 51% of people are going online first. It's the first impression with your house. So make sure that the material that you're putting out online, and when you put something on the MLS, it gets syndicated everywhere, right? So make sure that's good quality stuff. Don't cheap out on that part of it. This is the same stat about, look, where buyers found the home they purchased. And once again, those numbers, kind of correlate. 51% use the internet. 28% use their real estate agent, right? So, there's a lot of tech out there trying to replace us realtors. And I would advise most of you that, using a real estate agent, it still ends up being a local deal. So make sure when you're working with whoever you hire to help you sell your property is someone that's local and knows the local market. It's really important. All right, the last part is you've been fortunate enough to prepare your property, you priced it right, you got multiple offers through all the amazing photography and the staging of your property. Now you got to get it closed. Some considerations that I think that, apply to the self-directed IRA space is whenever we start, and remember that 5-week chart that I showed you of the prep that we do, one of the first things that we do is pull a prelim. I think it's really important from a self-directed IRA standpoint is make sure when you bought it, someone didn't make a mistake and put it in the name of your personal name versus in the name of your IRA or whatever entity that it should be in, right? So if there is a problem when you're with the title, get it resolved before you put the property on the market. Don't try to resolve it while you're in escrow. Secondarily, right, from a disclosure standpoint, right, you've never lived in the property because by definition you can't. That would be a prohibited transaction. Yet you still have to be honest and disclose whatever information you do know about the property. So, we always advise people to be honest, right? Most people, when they review disclosures, they don't it's usually not the things that are on the disclosure. It's usually the things they find that aren't on the disclosures that cause problems. And beyond causing problems, if they close escrow on the property, now you have liability, right? So, we always advise sellers to be overly honest in what they disclose, because it just protects them down the line from potential litigation, and more likely it'll help protect the escrow, right? If you do own a condo and there's an HOA involved, there's a whole nother set of disclosures that you have to, get involved through the whoever the property management company is that's running the HOA. So make sure that either you or your seller is on top of that. Be aware of buyers' contingencies, right? So when you do accept an offer, understand how many days they have for inspection and loan. Those are the two biggest contingencies that you have. So make sure that you're aware, and that whoever's representing you is holding your buyer accountable to those timelines. And then we recently helped sell a property for an investor that owned it within their self-directed retirement account. I always advise people, whenever there are asks from your buyer, if you're willing to grant them, right, it's better to give credits than to do the repairs yourself. And I think that's way more important inside a self-directed IRA, right? You can't go in and fix the sink. You have to hire someone to do that. But more importantly, when you take on the repair of the item, there's a kind of an inherent warranty that the buyer is going to think you have, versus if you give them a credit, it makes it more simple for you. And if whoever the buyer hires to do it, it puts that warranty or that liability on them and whoever that sub is. So we always advise clients that credits are better than getting repairs created. And lastly, look, make sure that you call utilities and insurance companies to discontinue service, right? So make sure that's a central part of, when you're in the escrow process, that you're going through and, making sure that whatever things you're paying for within your IRA to hold the property, that you're just continuing them, so you don't have, end up paying fees after close of escrow and then having to go back and try to recapture that. That's hard enough to do if you're doing it in a property you own in your own name. There's a whole nother layer of challenge if you're trying to navigate that through a custodian or through your retirement account. And then the last two slides that I have here, look, if you bought the property, you probably already understand the steps to escrow. And even this is a very California-based process. I'm not going to go through all of these items, but these are one of the things that we kind of use when we're highlighting, educating both our buyer or a seller. It's kind of the what to expect while you're in escrow. And I put these two slides in here, kind of takes you on a typical 30-day escrow. I figured if anyone was interested in this presentation, I do have the ability to send it as a PDF, and this would just be a nice reminder of what happens when you're in escrow. So with that, I will turn it back over to Munzer.
David, thank you for the detailed information. What an outstanding presentation. I'm sure our listeners will agree. So what's next, guys? We have an upcoming webinar, our next monthly webinar, Build to Rent Real Estate. Register today. Join us in 4 weeks, September 21st. You want to learn something new? Let us know in the survey as you leave, please. That's very important for us to know what our listeners like and don't like. Need more information about self-directed IRAs? Visit our website, theentrustgroup.com. Wealth of information there, a lot of resources. Sign up on the Learning Center. We'll have all the archived webinars, recorded videos in there as well, and a lot of just marketing collateral about self-directed IRAs, because again, all we provide is educational resources for you to better educate yourself about investing in your self-directed retirement plan. And as always, follow us on the social media for updates, Facebook, LinkedIn, Twitter, and what have you. So I think we are ready for time for questions. I hope we have some. So let's see. I think one of the questions saying here, David mentions removing photos of family, but you can't be living in the property your self-directed IRA owns. Right. Yes, I mean, obviously, David was alluding to the fact that the tenant that's renting from the investment property that's held in the self-directed IRA would remove their pictures. Is that right, David?
Yeah, and that was certainly, look, beyond just your family photos, right? Anything that might be controversial, right? Religion, politics, anything that gets in the way of a potential buyer from seeing themselves in the home is what we're talking about. But yeah, to the question specifically, absolutely, you cannot live in your own the property that your self-directed IRA owns. And Munzer, one of the things that I'm sure you've advised as well, a lot of people maybe want to buy a vacation home, right, and rent it 50 weeks of the year and then use it a couple of weeks of the year as well. That is also a prohibited transaction, right? So make sure that whatever you own in your IRA is purely being held for investment purposes and you're not taking any personal use out of it.
Absolutely, absolutely. We get that question a lot. People wanting to invest, and actually the interest group is one of the few custodians out there that we permit offshore properties investing. So a lot of our clients would opt to invest, namely in Mexico and other countries. And the first question I would say, hey, are you define a vacation home, right? I mean, are you looking to rent it out for 50 weeks, as you mentioned, and then use it for 2 weeks? And if the answer is yes, then that's a no-no. It has to be purely an investment property. Should you wish to one day vacation at it, then you can take it out as a distribution, pay the applicable taxes, and now it's a property that's not owned by your IRA. But yes, a good point there, David. I don't see any more. Let's see if there's any more questions.
Yeah, there's a few that just popped up.
Okay, let me see. Trying to get to it.
Okay. I'll take this first one because it's a really good question from Christine. Sure. About how much can you inconvenience the tenant as you go through the prolonged sale process. And Christine, here's the answer. You can inconvenience them as much as you can get away with. And here's what I mean by that. There's usually a certain amount of notice that you have to provide to a tenant as a seller before you can enter the property, right? In California, that's usually 24 hours. So you certainly need to abide by those minimum standards. But one of the first things that we do when we're listing the property, and again, look, we're not the seller, we're representing the seller, is we'll make nice with whoever your tenants are, right? Help them understand that, that we understand that they're in a distressed situation, right? Because they don't know if they're going to get kicked out of their house. They may have to move. They don't know. The nicer you are to the tenants, generally, the more they'll let you get away with. So it's definitely one of those situations where you'll catch more flies with sugar or honey than vinegar. So we love on the tenants just so we can hopefully, when we are inconveniencing them, we're giving them ample notice. We're trying to limit the amount of time or number of times that people are coming through the property. So what does that look like? If the seller wants to do inspections, have them get their inspections done in a day, right? Get their home inspection, their termite, their sewer, line them up. Even if it means that it's going to take a week to get all of those parties involved on the same day, better to do that so you less inconvenience the tenant. And then as a listing agent, I would take credit for that with the tenant. So if there is a follow-up inspection, but they know that I'm trying to limit the impact on them, they'll be less grumpy about us having to notify them.
Great, good information. I think the next question is I can address that. Can you explain the process for involving an interest representative in the sale? When does interest need to sign the document? So as both of us alluded to, keep in mind that the IRA owns the properties, right? So the IRA is on title. So we start from A to Z, if you will. So with the purchase agreement, it needs to be in the name of the IRA, sent to us so we can sign it. Earnest deposit to be paid will have to be paid out of IRA funds. Then we work with escrow, an officer of your choosing, title and escrow company of your choosing. We get all the escrow docs. We fund escrow, we close escrow, and now the IRA owns the property. So we're involved in every step of the way with your title and escrow officer, with your realtor, what have you. But we want to make sure at the beginning that everybody's on board, that the IRA is on title, right? And so on. Now, if you purchase the property, which many of our clients do through an LLC that's set up through your own attorney, then Entrust is not involved there because the LLC is purchasing the property, the LLC is on title, and so on and so forth. We, as the IRA, sorry, is just a member in the operating agreement that's purchasing the property. Therefore, we just fund the LLC, and then the LLC purchases the property.
Munzer, I see I see two good questions that I could probably answer here. One was from Barry asking, do we foresee a market correction regarding the price of homes? And prices have been crazy. And Barry, I think the way we answer that is we definitely see a price correction happening. Actually, what we see is more stabilization, right? And the return of something that we used to have that's been eliminated in the last 2 years, and it's called seasonality, right? We have been in such a high demand, low supply market for the last 2.5 years. There really hasn't been any seasonality, right? Like the demand just blew through, whatever times of the year people were looking for homes, basically year round, right? Starting this summer now, rates have kind of come, have gone up a little bit, right? And they're all of a sudden now, mid-June through the end of July, a lot of people were on vacation, which they weren't doing the last couple of years because of COVID. So I think what you're going to see is you're going to start seeing some seasonality, right? Selling the property in the middle of summer, you're maybe not going to see as much multiple offer situations versus if you're selling a property, in the spring, right? When the selling season starts. So, we're looking at it more stabilization. I do think there'll be in some markets, I've been reading all kinds of articles, some markets prices are starting to come down and other markets prices are actually still going up, right? So that's definitely a very local question, but I think in general, what you're gonna just start seeing is more market stabilization. We're not gonna keep growing at 20% year over year like we have the last couple of years. Most of the larger companies that we follow, CoreLogic and Zillow and NAR that track where they think home prices are going are actually still seeing an increase in pricing in 2022 and 2023, but just barely, right? Not the big year over year gains we've been seeing for the last couple of years. I think we're gonna start seeing more stabilization.
Great. I think there's a question here. Also, would doing any kind of staging work yourself, not paying yourself for it, just moving furniture around or using your personal furniture temporarily, etc., will be considered sweat equity prohibited? Yes. I mean, David had alluded to that. David, if you have any other comments on it, but obviously you want to stay away from any sweat equity because it's indirectly benefiting your IRA.
Yeah, I mean, Munzer, I think the technical explanation on that one is that is a prohibited transaction. However, I'd advise the practical is that, look, if you're just doing some minor stuff like that, you're probably okay, right? Like, as far as I remember, Munzer, there's no self-directed IRA police running around, right? Your biggest liability is if there's an audit. Well, let's say you do an audit of the property, right? And inside the listing of the property, the realtor writes the house was just freshly painted inside and out. And the auditor is going to want to see where that receipt is, right? Well, if you don't have a receipt for something like that, that's where you could be subject to some liability, right? If you're, putting some furniture in, moving it around, that's the type of thing that you're probably okay with and could get away with. But, obviously, from my personal experience, we think staging matters a lot. So, if it's the, what's the value of hiring a professional staging company with modern furniture that knows what buyers in that area are looking for and what they find current versus you using some older pieces and just kind of moving it around, you're probably okay with it, but I would argue that you'll probably get more for your property if you hire a professional.
Absolutely. I don't see any other questions. Do you see any more, David? I don't.
Yeah, there's two more. It says, if we understood correctly, siblings or spouses of siblings or cousins could be involved in these transactions without issues. And that is correct. So if your brother's a contractor, you can hire him to come in and do work. If your son's a contractor, you can't.
Yeah, that's correct. And I've always said, I mean, jokingly, I said, it does, you know, it's one of those things that really do not make any sense. My guess is the person that wrote it in the IRS does not have a brother, sibling. I don't know, but yeah, what I would always say is do that with caution. And if you do have a sibling that you want to rent the condo to or do some work to it, do it with fair market values, right? And make sure you rent them at a fair market, make sure you pay them fair market value and so on. So there are no, you know, issues there.
Cool. I think the last question, Munzer, you already asked or answered. It was about, you know, where does Intrust get involved on signing off on all the docs in the process?
Okay, so that was it. Yeah, I'm sorry, I'm not seeing the questions in order here. So thanks for helping out there, David. And again, that brings us to the end of today's webinar. I want to thank all of you for attending, and special thanks to David. It's been a while, it's been a minute, David, since we shared the mic. It's great to have you on board. Thank you so much again. Our information is right there. Please, if you have any questions about self-directed IRAs, feel free to reach out to me. There's my email. Additionally, my direct number is 310-496-4216. David's information right there. He's more than happy to assist you with any questions you may have about buying or selling real estate properties, especially investment properties or related to self-directed IRAs. Again, thank you all for joining us. Hope to see everyone next month. Thank you so much.
Thank you.